Thank you so much for joining in for this live session where we will be decoding the long-term strategies. We will start the session in just 1 minute. Hello and welcome to this live stream. I am Kavita Agrawal and the live stream is brought to you by ET Livestream. I am the founder of EXP-Invest and today we are going to discuss a very important topic. The topic is basically about long-term strategies. What do I mean by that? Let's move forward towards the slides and decode things one by one. All right, so now what you can see on the screen is the PPT which I have prepared for you. And as we start with this session and carry on, please feel free to post your questions about what is going on your screen. At the end of the session, I will also be very happy to answer your questions. So in today's session, we are talking about how to adjust your long-term strategies. We will cover a lot of questions. Right now, the market condition is such that it calls for a major mindset shift. We need to start asking the questions about the prowess of this buy and hold strategy. Basically, जो इतने सालों से चलते आ रहा है कि buy and hold is the best strategy in the market, its prowess is unquestionable. But given the next few years, is it the best time to deploy that strategy or stay true to that strategy? That is the question that we are going to answer in this session. Basically, buy and hold strategy the popular क्यों है? Because all the ace investors that we know are predominantly value investors who have made massive sums of money in the stock market by using this buy and hold strategy. But like everything else in the world, this strategy is not free from all sorts of drawbacks. There are some drawbacks and we will discuss that in the strategy in this session. We will also answer some important questions. For example, what is the current situation that is staring us in the face and why does it call for a shift in our mindset and updating our long-term strategies? What should you do about it? How should you go about it? And when should you do it? So let's start with the first let's first start with some definitions. We will go over what are the different long-term investing strategies. As you can see on the screen, long-term investing strategies are basically broadly identified as the buy and hold strategy, which is nothing but buying stocks and other assets and holding them on for extended period of time, which can typically be several years or even decades. Now, the first kind of long-term investing, the easiest kind of long-term investing strategy is the index fund investing. That is the first one. Now, in the index fund investing, it basically means you copycat a popular index, which in India can be index the Nifty 500. In the US, it can be S&P 500. So the idea is nothing but to just hold the investments or the stocks which are part of a major index. It can also be Nifty 50 for a long term at the weightage which is maintained in the index itself. And it has been shown historically that these funds do well. So if you want to at least map the stock market returns, then index fund investing is the best strategy for you. All right, the next strategy is dividend investing. Dividend investing is very suitable, very correct for those people who are looking for passive income. So what you basically do is you invest a sizable amount of money in companies which have a good track record of paying dividends, and then every quarter or every half yearly or every year when they pay dividend, you get passive income out of it. Now, the drawback here in dividend investing is that there is no guarantee that a company which has been paying dividends since the last, say, even 20 years is going to pay you dividend next quarter or next year. This was witnessed in the Royal Dutch Shell, which is a company well known for paying dividends. Last year, when the COVID hit and the oil prices tanked, it was a historic moment when the Royal Dutch Shell did not pay any dividends to its investors. It created a lot of upheaval, and I know because I was working in Royal Dutch Shell and I know how stressful it was for not just the investors but also for the employees to not receive dividend, which actually, especially for marquee investors, for old investors, it is a major part of their regular income cash flows. And that is why dividend investing is a great strategy, but of course it has its own drawbacks. Moving on to growth investing and value investing. As the name suggests, growth investing and value investing are basically finding companies which have either great growth potentials in the future, which can be determined on the basis of stringent analysis of the company books, or if you are an expert in that particular market field. And value investing is nothing but investing in stocks which you perceive as undervalued. Now, these terminologies are being used widely, but you have to understand there is a lot of research that goes behind determining whether a company is a growth company or a value company. And for retail investors, it is very important to understand that just because something is being told on TV, or just because a company is being called as a growth company or value investing or a value stock, it does not necessarily mean that way. The problem is that with growth investing and value investing, if you want to really determine the value of these stocks, you have to wait out and let your investments play out for nearly 5 to 10 years, which can be a massive time commitment for majority of Indian retail investors, right? Now, the fifth one, dollar cost averaging. Now, dollar cost averaging itself is not a strategy. It is more of a technique which is deployed by long-term investors. And from what I am seeing in my interaction with my members and a lot of retail investors every day, is that dollar cost averaging happens to be one of the most commonly abused form of technique in the market. Why? Because a lot of people think that because they have made investments at the wrong, say at a high price, they tend to get into the market, or they tend to get into averaging of their holdings just because the prices are falling, without any idea of whether the market is in for further decline or in for a turnaround anytime soon. So dollar cost averaging does include making investments over a period of time, over specific or equal intervals of time without any consideration for market conditions. However, what needs to be given a lot of consideration is the fact that dollar cost averaging can lead to a lot of money getting stuck in the investments without seeing positive results for a long time. And if you don't have an idea about which direction the market is going to go, or if you don't have a solid strategy backing what you are doing in the market, then you will see your capital just getting sucked into your portfolio without giving you any returns. All right, now we are going to jump right into the drawbacks of what these different strategies can present. And these drawbacks are very important to be talked about because the stock market is heading towards a very important juncture. I will come to that in the next slide, but it is very important to know the drawbacks of these long-term strategies, because a lot of time retail investors especially start participating in what they believe is a long-term strategy for their portfolio without knowing how it might damage their portfolios in the long term. All right, so firstly, let's talk about the buy and hold strategy overall. The buy and hold strategy usually considers usually deals with a time frame of around 5 to 10 years, and it requires a lot of patience and discipline naturally, right? Buy and hold strategy is also a strategy of the rich. Now, hear me out before you react. What do I mean by strategy of the rich? Basically, in buy and hold strategy, you need to have ample capital at your disposal to be able to add to the portfolio, to be able to allocate to the stock market regularly. This situation is not something I would say is possible for majority of the Indian population. That is why I call it a strategy of the rich. If you are somebody who earns a who is a salaried class person, who is paying around 50 to 60% of the income in direct and indirect taxes, have a specific say 25 to 50,000, even 70,000, even 1 lakh of corpus every month to allocate to the stock market, and you don't have a lot of capital sitting by way of inheritance, then the buy and hold strategy can do you more damage than good if you are not doing it properly, if you're not taking help of a professional analyst, to which I will also elaborate more in the coming session. Now, when you do buy and hold strategy, there is also significant risk of market decline. Now, this is also why I think buy and hold strategy can be very risky if deployed improperly, because when you're taking a chunk of your savings and investing it in the market, you naturally want it to grow. But if the market conditions are not right, or if you've not been prudent about your actions and the market goes into decline, this will impact your standard of living and your long-term goals. So you have to be careful. The fourth drawback of the buy and hold strategy in general is that it could result in substantial losses, which I've pretty much covered in the previous points. Now, specifically about the dollar cost averaging strategy, which a lot of people consider, a lot of people understand that if a stock has gone down 10-15%, it's okay to add more. That is not how dollar cost averaging works. You have to take into consideration the future prospects of the stock, whether the stock is going to go up or not. And if the stock is going to go up, what is the time frame that you can expect such a turnaround to come in? A lot of times technical analysis really helps in that because it gives you an idea of where the support and resistances lies. So if you are confident about the companies that you're investing in, if you're confident about its market, its business and its margins, then adding more to your portfolio around the support levels is a great strategy for cost averaging your portfolio in a market decline. But in situations where you're just blindly investing, especially on the basis of things you've heard from TV analysts or your colleagues or your friends, not a very good strategy, right? Now, talking about the value investing and the growth investing, picking individual stocks for investment is risky and it's time consuming. It requires very high level of analysis and knowledge and information processing. Poorly performing stocks or lack of research could result in significant losses. This is very obvious. This is something being experienced by a lot of people out there, so I don't need to explain this a lot. Now, asset allocation, I've also included asset allocation and rebalancing here. The reason is that a lot of people don't give enough focus to asset allocation. This has become even more evident in the last couple years, especially after the post-COVID rally that we have witnessed, which was something we've never seen before, right? So it really is important to understand that you're allocating your available assets in the proper manner, along with managing your risk tolerance, your investment goals, and taking into consideration how the market is going to behave in the coming times. Again, rebalancing can also be time consuming and may result in transaction costs that eat into returns. All right, let's now move on to the actionables. What can be done in a market like this, right? All right, so there is a possibility. So right now what we are looking at in the market, I as a technical analyst with experience of over 10 years can tell you that there are indications on the charts of Nifty which are saying that over the next couple years we can see a massive decline of 10 to 25%. Right, it's a huge claim and I'm aware of that, and I will be getting into the details of that next week, that is on This Friday session, I'll be coming live at 2:30 p.m. and I would love it if you would join. If you wish to get notified about this, you can join my Telegram channel, and over there I will be posting about this live. All right. So what should you do considering that there is a big market decline coming up in the market or is expected to unfold in the market? This is obviously not news, because you can see globally the trend of negative news has gone up, and not just that, most of the negative news is related to socio-economic circumstances which impact the stock market, obviously. So what should you do? Start with reassessing your own risk tolerance. A lot of people usually overestimate their risk tolerance without realizing how much a massive decline in the market can damage their portfolio, their morale, and their living standards. So firstly, start with reassessing your own risk tolerance, because market declines are emotionally challenging times, and it's important to assess in real time how much risk you can take. These days, loss of job is a reality that was not being taken into consideration. Job insecurity has become a reality now, with so many layoffs happening, and that adds another layer of risk to our existing conditions. So that's about reassessing the risk tolerance. Now, the second thing that you should do is reduce your exposure to equities, and this is considering the forward-looking outlook of a supposed market decline. It's obvious that having more equity exposure is going to impact your net worth negatively over the next couple years. So reducing equity exposure and opting for safer investment assets, for example debt or bond or cash, or just sitting on cash, is a better alternative. If you're opting for rebalancing your portfolio, then you should also be very careful. Your objective should be purely to realign with preset long-term investment goals, which should be in line with your reassessed risk tolerance. This will involve for you selling overvalued stocks and investing in fair and undervalued stocks. How do you come to determine whether a stock is undervalued or overvalued? We will answer that in the next slide. Now, if you are somebody who loves doing dollar cost averaging or cost averaging of your stocks, basically, if you're somebody who is not very good at determining an exit strategy, and if you're witnessing, and when you witness that your stocks have fallen 15, 20, 30%, you think cost averaging would be a good strategy, just stop and take some time. Because there is no guarantee that a stock, if it has fallen 30-40%, is not going to fall further. We are witnessing that in big names. For example, you must have seen what happened to Unitech, you must have seen what happened to Yes Bank, you must have seen what happened to the Satyam stocks, you must have seen what happened to Freetail, right? These were very well established, very good names, and look at what has happened. So dollar cost averaging is not always a good strategy. It is a very dangerous tool. It's a very dangerous weapon which should be used very carefully, because if you're doing dollar cost averaging carelessly, what's going to happen is you will end up with more of loser stocks in your portfolio, whereas you should have been allocating more capital to winner stocks, right? All right, so how should you go about it? How should you go about tweaking your long-term strategy? Seek professional advice. It is mandatory. A lot of people don't realize this, but it is mandatory to consult a research analyst, especially during periods of market volatility, to gain insights and get recommendations tailored to individual investment goals and risk tolerance, because stock investing is highly subjective. What do I mean by that? What do I mean by stock investing being highly subjective? A lot of people think stock trading or portfolio building is all about buying stocks at low price and selling them at high price. That is true, right? On a very simplistic level, that is exactly what it is. But you also have to take into consideration a lot of things which can be very different for different people. For example, time horizon. You might be wanting to invest in a stock for 3 months. I might be wanting to invest in a stock for 3 years. Is it advisable for both of us to buy the same stock? No, it is not, because